Where Are We Going in 2024? An article by Mike Adams. 85% of economists predicted a recession in 2023. So did most CEOs and everyone on Wall Street. Their almost unified approach was to sell US stocks, buy bonds, and buy Chinese stocks. All three were dead wrong. US stocks did well. Bonds caved, Chinese stocks cratered. What does that tell us about 2024 and beyond? In our opinion, it tells us a lot. The large majority were convinced there was going to be a recession, and their investment calls were based on the coming recession of 2023. For over 2 years, we said the chance of a recession was very small. Albert Einstein said that the speed of light in a vacuum was constant. No matter who measured or where it was measured, it would always be the same. That is true about the law of physics, chemistry, and biology. Wall Street and economists seem to apply that same logic. Those gurus who continued to predict recession elevate past economic event status to the same constant that Einstein did for the speed of light. 100% of the time in the past, when the yield curve inverted, it was followed by a recession. The same has been true of the Federal Reserve raising interest rates. If it did not happen in 2022 or 2023, then they think it will be in 2024. That has been their reasoning. But as we believe the times are really different, the world was coming out of a pandemic. People had sheltered in place and received stimulus checks. In addition, the Fed said there were 4 million more jobs than were workers to fill those jobs. In the past, when the Fed was raising rates, there were widespread layoffs and often more workers than jobs. Economic activity was slowing, unemployment rising, and wages falling. Just the opposite has been true in 2022 and 2023. United States GDP is showing accelerating growth. What does this mean going forward into 2024? Inflation. Inflation was the theme in 2022 and in 2023, and it will very well probably be the theme of 2024 and could be for the rest of the decade. There's wide consensus that the Fed is going to be lowering interest rates. Inflation has come down, and while it might not reach the goal of 2% in 2024, most economists in Wall Street feel rates will be down. At AFC, we also believe that to be the case, as much because there will be considered political pressure from the administration for political gain. While inflation has come down, it will probably continue for a few more months. Our concern is that we feel inflation will probably begin to rise later in the year. Demand pull, inflation happens when then there is more demand for goods and services than there is supply. An example of that is what happened in the used car market in 2022, when a shortage of used cars caused prices to catapult upwards. As COVID ended, there were a number of shortages and inflation surged upward. As supply has returned, price increases have fallen, and it seems like the Fed is managing a soft landing. Cost push inflation happens when wages and material costs rise, pushing up prices. The United States created 2.7 million jobs in 2023, and 3 million people joined the workforce. Wages rose 4.6% in the last 12 months, ending in September 2023. That compares to around 2.5% pre-pandemic. Inflationary pressure increases when wage growth outpaces productivity. Productivity from the end of 2019 through the second quarter of 2023 was just 1.2%. We believe there is a definite possibility that inflation will gradually fall during the year in the early part of 2024, then bottom and begin to rise and increase later in the year. Inflation does begin to increase. The Fed will once again raise rates. This time, the Fed may have to continue to raise rates until there is a recession where job creation becomes negative. Stock market. We believe the stock market will probably do well in the first half of the year, but could be vulnerable if there is a shift in inflation as the year winds down. We expect there will be to continue more jobs than workers to fill them. Wages will increase, and companies will be raising prices to accommodate the increasing wages. Once the Fed begins to raise rates, we would expect most of Wall Street and economists will look back on 2022 and 2023 when they did so misjudge the impact of the Fed raising rates and the inversion of the yield curve. They will remember there was no recession. As they were wrong in the last 2 years, they will probably be wrong again. We believe the stock market should do well early in the year, but as the year unfolds toward the election, it will be a stock picker's market, just as it was in the 1970s. In the 1970s, both bonds and stocks cratered. Should the scenario of reignited inflation play out, success will be in finding those stocks that will increase in spite of inflation. It will be a stock picker's market with indexes suffering. Bonds. If our scenario plays out with inflation increasing late in 2024 and beyond, bond yields will increase and the price of bonds will sink. In the 1970s, long maturity 4% AAA bonds fell as low as 30 to 40 cents on the dollar. Short-term bonds could not keep up with the pace of inflation. Bondholders lost money, whether short or long-term. In 2008, asset allocation that was supposed to limit risk did not work. The financial plans of retirees and those investors in their 40s, 50s, and 60s fell short. The result was retirees had to cut expenses, parents had to rethink college plans for their children, and pre-retirees had to think about extending their retirement date. We believe success in investing and meeting goals may well require a different approach. And there ends our article.